welcome friends once again to this NPTEL MOOC module on international trade theory and empirics. We are now explaining the exchange rate dynamics. In the previous lecture, we have discussed the the monetary theory in the context of balance of payment and foreign exchange market. How the balance of payment theory is largely discussed as a monetary theory. Okay. I think just to give you the brief discussion that monetary theory discusses largely on the long run, and they nowhere address the short run changes, but we will also discuss about what kind of short run discussion they give it, how short run explanation have been made in the exchange rate dynamics. Okay. So, what is the reasons behind exchange rate dynamics, how the changes dynamics occur, there are so many factors, some of the factors we already discussed. Now, to address this I need to take you through with certain examples, then more arguments will follow accordingly. Now, coming to the understanding through the monetary approach once again, the views that the balance of payments largely is a monetary phenomenon. Money plays a crucial role in the long run as a disturbance and also as an adjustment. Okay, we have seen that in the short run case, adjustment to the balance of payment is very difficult, especially in the fixed exchange rate regime. Adjustment takes time, and since it is short run and that too it is a fixed exchange rate regime by assumption, that lead to disequilibrium in the balance of payment. Okay. But in the long run, under flexible exchange rates regime, as well as in the countries where reserves are quite good, they have no problem in the short run as well. So, let us count down all those discussion once again to relate to the disturbances or foreign exchange dynamics. We have kept it as under fixed exchange rate, a balance of payment surplus results from excess stock of money demanded that is not satisfied by its domestic monetary authorities. Okay. If there is excess stock of money demanded, what do you mean by that? The money demand is due to various forms of demand through the asset market maybe. Okay. And there will be more demand for its goods and commodities, there will be more exports of those commodities. So, there will be a surplus in the balance of payment. Okay. And a balance of payment deficit is just the opposite, where excess stock of money supplied that is not eliminated by the monetary authorities, or there is no enough demand for those excess supply. The surplus or the deficit is temporary and self correcting in the long run, especially in the context of fixed exchange rate. But in the flexible exchange rate, I think in the short run also it is self correcting. So, need to check it, you doubly sure that you have understood this aspect, and compare this with the flexible exchange rate system. Okay. And also I have mentioned that especially some countries where the currency reserve is not a problem. So, they have also not required to wait for the long run. Rather, the disturbances could be self correcting in the short run by utilizing the currency reserves within the country. Okay. So, that is why the last point is that except for currency reserve nation, the nation has no control over its money supply in the long run under fixed exchange system. Okay, even in the long run, the country has no control in money supply. Okay. Now, the repeating the earlier discussion and trying to understand the dynamics through these two exchange rate system. The balance of payment disequilibria are immediately corrected by the automatic changes in the exchange rates without international flow of money or reserves. That is why we said it is possible under flexible exchange rate. Nation retains dominant control over its money supply and monetary policy. Okay. And the adjustment occurs as a result of the change in domestic prices accompanying the change in the exchange rate. So, we have already discussed in the previous lecture that there will be adjustment through the prices. Okay. Now, once again addressing the relationship between the money supply and exchange rate, we have said that money supply is directly related to the exchange rate. That means the exchange rate increases, which means that the value of exchange rate actually depreciates. Okay. Now, in this picture, when money supply increases relative to another country's money, so the value of that particular currency actually declines or decreases, and accordingly the rate actually increases. So, we move from point A to point B. So, this the simple diagram from Salvatore explains the relative change or the dynamics in the exchange rate. In this context, it is valid to identify one of the important discussion in the macroeconomic model prescribed by Dornbos. Okay, Rudy Dornbos, economist, who talked about exchange rate overshooting. Okay, it overshoots and gets balances, gets stability in a different time period. And this hypothesis, that is exchange rate overshooting hypothesis, was first developed by economist Rudy Dornbos. Okay. Now, it is important and interesting, it is an important and interesting extension of the Mundell-Fleming model. The Mundell-Fleming model, we have already seen that in the 3 market setup, okay, how the monetary policy and fiscal policy work together to get the equilibrium in an open economy model. So, it is important and interesting extension of the Mundell-Fleming, a static small economy ISLM model. This is also called a small economy ISM model, as it allows for price adjustment over time and rational expectations formations as well. So, it is an extension, it is a static open economy ISLM model, and it allows price adjustment, also talks about rational expectations. Okay, how expectations have been also incorporated in this particular model. This is a theoretical explanation for high levels of exchange rate volatility. So dynamics we are discussing. So, the theoretical explanation of the volatility. The key features of the model include the assumptions that goods prices are sticky. Okay. The assumption is that goods prices are sticky or slow to change in the short run. So, 3 important things to be noted, but the prices of currencies are flexible. Prices of currency and their value, that is exchange rate, nominal exchange rate is flexible. So, that arbitrage in an asset market holds via the uncovered interest rate equation. And we will also discuss now what do you mean by uncovered interest rate parity equation, and that expectations of the exchange rate changes are consistent and that is rational. So, expectations of the exchange rate change regarding the exchange rate is actually consistent and very rationally decided. Now, coming to the uncovered interest rate parity, which we have just unfolded. which says that when the no arbitrage condition is satisfied, there is no arbitrage condition, without the issue of a forward contract to hedge against exposure to exchange rate risk, interest rate parity is said to be uncovered. So, without the forward contract to hedge the exposure of exchange rate risk, so interest rate parity is said to be uncovered. So, risk neutral investors will be indifferent among the available interest rates in two countries, okay, because the exchange rate between these two countries is expected to adjust such that dollar return on the deposits of dollar is actually equal to the dollar return on euro deposits, thereby eliminating the potential for uncovered interest rate profits or arbitrage profits. Uncovered interest rate parity helps explain the determination of the spot exchange rate. Okay. So, it is not about the future, rather it is related to the spot market. Now, when we discuss about that the features of the model of the exchange rate overshooting include the assumption that goods prices are sticky and slow to change in the short run, but prices of currencies are flexible, that arbitrage in asset markets holds and via the uncovered interest parity equation, and that expectations of exchange rate changes are consistent and that is rational. Okay. So, this is important to note. Now, stock adjustment in financial assets are usually much larger and quicker to occur than the adjustment in the trade flows. All right. Most of the burden of adjustment in exchange rate comes from financial market in the short run. All right. And thus exchange rate must overshoot or bypass its long run equilibrium level for equilibrium to be quickly re-established in the financial market. Since most of the burden of the adjustment in the exchange rate comes from financial market in the short run, okay, and long run it gets stabilized, and the stocks adjustments are much much larger and also quicker than that of the trade flows. Therefore, exchange rate must overshoot. This is one of the important explanation regarding overshooting than that of the long run adjustment. Okay, uncovered interest rate parity we have discussed, but still another 1 or 2 point is that uncovered interest rate parity asserts that an investor with dollar deposits will earn the interest rate available on their dollar deposits for sure. Okay. While an investor holding euro deposits will earn the interest rate available in the euro zone, not in the dollar zone, but also a potential gain or loss on euros depending on the rate of appreciation or depreciation of the euro against the dollar. That means whatever is there in that particular market will be there since it is uncovered. Okay. Economists have extrapolated a useful approximation of uncovered interest rate parity that follows intuitively from these assumptions. If uncovered interest rate parity holds such that an investor is indifferent between dollar versus euro deposits, then any excess return on euro deposits must be offset by some expected loss or depreciation of the euro against the dollar. So, this is what we have discussed about uncovered parity as against the covered exchange rate parity. Then what are the assumptions of the model, that is the exchange rate overshoot model proposed or discussed by Dornbusch, that the aggregate demand is determined by the standard open economy ISLM mechanism. In the ISLM mechanism, goods market and money market equilibrium holds with the open economy balances. So, the aggregate demand is actually defined by this framework only. Then only we can able to address the exchange rate overshooting issues. Financial markets are able to adjust to shocks instantaneously, and investors are risk neutral. Okay. So, investors are therefore risk neutral. In the short run, goods prices are sticky. Good prices are not going to be changed instantaneously, rather in the short run it is sticky. that is aggregate supply is horizontal in the short run, aggregate supply, therefore, the price is determined at that level only. Okay. Though it is positively sloped in the long run, but in the long run the aggregate supply is positive slope, but in the short run it is completely horizontal and price is sticky as mentioned by Dunbos for exchange rate overshooting. In this model, what we have seen that if there is a 10% rise in the money supply, okay, here by 200 210, right, that is reflected with a change in the interest rate and the prices, okay, but not so quickly, okay, and also on the reserves. So, now on the first part I think we have discussed here, the most important insight of the model is that adjustment lags in some parts of the economy can induce compensating volatility in others. Specifically, when an exogenous variable changes, the short run effect on the exchange rate can be greater than the long run effect. So, the short run and the exchange rate overshoot its new equilibrium long term value. According to the model, when a change in monetary policy occurs, the market will adjust to a new equilibrium between prices and quantities. Now, coming to this model, what we have seen that price is sticky at 100, even if the money supply increases from 100 to 110, price is not going to be reflected very quickly. It is very sticky till T naught period. In the T naught period onwards, there will be a steady rise in the prices, not a quick rise. Similarly, it is also reflecting the reflecting on the what we call on the interest rate as well. Okay. Now, coming to the exchange rate, that from it, if it is initially 1 till there will be major jump quickly because of the changes, all right, changes in the money supply, but in the long run it stabilizes to 1.10, okay, by assumptions, all right. Now, further details on it we can follow it to the Salvatore book on exchange rate overshooting. I think I have just discussed about this, how in the short run it gets quickly reflected in the in the exchange rate, whereas over the time it gets stabilizes, okay, to another level, that is 1.10. All right. Now, regarding the overshooting aspect, that is overshooting a dollar exchange rate, there are some figures taken from the book of Salvatore. We have cited the source, that there are huge fluctuations. Okay. From 73rd onwards, when the floating exchange rate regime started, the market automatically gets corrected and stabilizes to a level 0. Okay. All right, then this is the figure on Japanese yen for US dollar. Previous one we discussed about mark as against dollar. Okay. Then there are some recent evidences as well, that the empirical evidence from small economy has not in general been supportive of Dunbos overshooting hypothesis. Okay. Some paper cited that in small economies the overshooting may not occur, all right. In fact, in many cases the literature has found puzzling results suggesting that exchange rate depreciates after a positive shock to domestic interest rate. Okay, mentioned by Rassete and Renault 1992, Simpson 1992, Greeley and Robini 1995, and Angeloni et al. 2003. Okay. So, they said that in many cases the literature has found puzzling results. That means there are mixed results may occur and may not occur. In some cases it is true and in some cases it is not true. A small, a long and persistent horn shaped, like increases and jumped and remain somewhere balanced. The exchange rate overshoot in the short run, then come back to a stability in the long run, which you have shown in the diagram shown by Dominic Salvatore. Long and a persistent horn shaped appreciation of the currency after a contractionary monetary policy shock has been found. The so called delayed overshooting, that is Eisenbaum and Abham 1995, Greeley, Robini 1995 and Lin 2003 discuss about this horn shaped appreciation of the exchange rate after a contractionary monetary policy shock has been found. Okay, and that is persistent in the long run. This is also inconsistent with Dunbar's model. Dunbar's model discuss about the short run issue, okay, that there will be overshooting, okay, as against the long run changes, and in particular with the expected depreciation that would make uncovered interest rate parity hold after the initial appreciation of the currency. Alright. So, whatever the recent evidences is actually inconsistent to the discussion we have made. So, a point to be noted here that this is inconsistent, alright, and some empirical evidence also suggests that open economy has not in general been supportive to the Dunbar's overshooting hypothesis. With this we have covered the overshooting aspect of the exchange rate dynamics, and regarding the further details of exchange rate dynamics in the diagram, we will take it forward in the next week. Once again I will also explain in detail. Okay. So, with this I think I should stop here. I will look forward to all of your participation in the next class. Thank you.